Hello, everyone, and welcome to this next episode of the Sustainable Connections podcast. If you are one of our more regular listeners, you'll know my voice and who I am. But for those of you who might be first time, I am Mark Lee. I'm the Global Director of Thought Leadership at ERM and really feel fortunate to get to host these conversations that we have. The concept of Sustainable Connections is to bring together different voices and look at the big issues or challenges in sustainability and the ways in which they kind of need collective thinking or work to overcome. Today, I'm doing a conversation with just three of my colleagues, and we are going to apply all of their expertise and knowledge to the EU Omnibus and try and break down this significant new proposal from the European Commission and what it means in terms of reporting and transparency and sustainability from a corporate perspective. So want to dive right in because we have a lot we want to cover today. And the first thing I'd like to do, of course, is to introduce the three people who are with me. And fortunate to have a spread of folks in different parts of our business from across North America and Europe. First one of those is Jennifer Klie. Probably going to call you Jen during the course of this conversation, but Jennifer, why don't you introduce yourself?
Thanks, Mark. Yes, I'm Jen Klie, and I'm in our North American business. I have been spending the last 15 years focusing on sustainability, strategy, and disclosure. And the last 18 to 24 months have been really heavily focused on helping our North American clients unpack the impact of impending ESG disclosure regulations, in particular the CSRD.
Terrific. And we'll get into the regional impacts of this as we get through the conversation too. Also in North America, real close to me in California, is Aiste Brackley. Aiste, please.
Hello, everyone. Great to be here. Aiste Brackley. I'm based in the San Francisco Bay Area in the US. I'm a partner at ERM, and I'm also the director of the Sustainability Institute, which is our thought leadership platform. I'm a European transplant in the US, so it's been fascinating to watch the developments of the last few months and just really to compare notes and to track, where we are with sustainability and what that means for businesses worldwide.
Great. I have no doubt your kind of transatlantic, both sides of the Atlantic view will play well and be helpful in the conversation today. And finally, third colleague with me today is Johann Weicht. And Johann, please introduce yourself.
Thank you for having me on the podcast. My name's Johann Weicht. I'm a partner with ERM. I sit in our office in Berlin, Germany, and like my colleagues, do a lot of work in the ESG reporting and disclosure space. I sort of switched over to ERM at a very interesting time, having worked more on the sustainability assurance side of things at a different firm, when sort of the switch from voluntary to regulated reporting just started, when was still the NFRD as the acronym and not yet the CSRD. And then sort of as soon as CSRD started taking over the main stage, switched over to ERM and pretty much have been doing nothing but CSRD and Taxonomy and SFDR and, all the fun acronym work ever since. And a bit of a split focus really between the more technical side, think accounting manuals, as well as, still having a good story to tell for our clients. I'll leave it at that.
That's perfect. I know the arc of your timing joining ERM and that shift from voluntary to mandatory or regulated reporting is, of course, part of our story today. And some of those things are shifting directions or at least changing pace, which is part of what we're going to explore. Johann, I want to stick with you. You seem to know so many acronyms. I may as well take advantage of it. And we'll have to try and maybe explain some of those as we go through today, at least when we hit them the first time. I'm assuming with listeners a high degree of knowledge around the omnibus, but we're not going to assume everybody's got all the details, and we're actually going to start just there. So Johann, can you give us the what is it and why is it so important? People were waiting for this thing to drop a few weeks ago for a reason, I assume.
Not just one reason, I would say. So the EU Omnibus, let's start with the term. It's the name of the vehicle the legislators in the European Union are using to review several pieces of sustainability reporting, but also sustainability due diligence legislation under the same umbrella with a shared set of objectives in mind. Keeping it short for now, let's just say it's about simplification in the spirit of maintaining competitiveness of the European economy.
Okay, that sounds like there's a lot laden in there. And Aiste, I'm going to take this to you and say, why? What were the drivers behind this thing? Why is it upon us now in 2025?
And we could have several podcasts to explain why, right? Many reasons, but I think
and then we could all probably disagree. So yeah, we could.
Sure.
Could have one from each point of view. Yeah.
Absolutely. But I think ultimately it just really boils down to two things. One, probably the most important one, is part of a larger effort by the EU to increase the competitiveness of the European economy. We have the EU facing competition from China and the US, global trade tensions, and really a lot of concern about very sluggish growth in the EU. And a big factor for this was a report issued by Mario Draghi last fall, who was the former president of the European Central Bank. And he noted all of these things and also recommended that the EU should cut the red tape and should focus on decarbonization and clean energy as part of its competitive advantage. So really the Omnibus is part of a much larger package. And some of the estimates are that this package will inject at least additional 50 billion euros into the European economy. And I think you can't have a competitive economy if you have too much red tape. And that's really the second reason why we have seen the EU Omnibus proposal released. The companies said that there's too much regulation, it's unclear, and it's simply too hard to do business in Europe. So I think the EU Commission is reacting to that, proposing to make the regulations more simple, to clarify some of the things that are unclear and in the gray territory, and just to simply to make the life easier for European companies.
Thanks, Aiste. Perfect. And we're getting there in terms of the what is it, why has it happened? And I think the hints in the name Omnibus suggest there's more than one part. And so, Jen, can you break this down? Which policies, which pieces of legislation that previously existed are now affected by the Omnibus? And why are they the ones that we're focused on streamlining?
Sure, Mark. There are four primary legislations that are impacted by the omnibus. The first is the Corporate Sustainability Reporting Directive, CSRD, and that is very broad sweeping reporting legislation. Tied to that is the EU Taxonomy, whereby companies need to report on their sustainability aligned OPEX, CAPEX, et cetera. It also talks to the Corporate Sustainability Due Diligence Directive. So that is really about what are you doing to ensure both environmental and human rights issues are being managed within the supply chain. And finally, the last piece that is impacted is the Carbon Border Adjustment Mechanism.
So lots of parts. There's so much complexity in each of them. We truly, I said to your previous comment, we could have a podcast on each, and maybe at some point we will. But today we're going to try and keep them all in sight. Before we dive into some of the specific elements, I just want to invite each of you to say what's one thing that struck you as particularly important, maybe surprised you, maybe excited you about the Omnibus when it released. And Jen, why don't you take that first?
So I think one of the things that we've heard universally among our clients, certainly here in North America, is how unprepared folks were feeling for the initial timeline, which would have most of the clients I'm working with reporting January or first part of 2026. So there's been a collective sort of sigh of relief that there is a little more time to be prepared. And yet also this growing recognition that even with an extra couple of years to get prepared, even with the potential simplifications, it's still going to be a long road ahead.
Yeah, there's a high degree of complexity here, right? And it's new for everyone. Aiste, your view, just something that struck you off the mark?
Yes, I think one important thing to note is that it's just a proposal. So we recently had the vote of the European Parliament and the Council to move ahead with a stop the clock directive, which essentially will stop the clock for companies so that they have more time. But I think we have the guidelines from the EU Commission of what it would like to achieve, but there will be still a lot more negotiation and a lot more change. So from what we have now, the EU Omnibus proposal, we probably will end up with something that is even just a little bit different. So I think keeping that in mind is important as companies prepare for these new rules.
Yeah, so emphasis on the proposal, right? And we don't quite know what this is going to look like at the end. And Johann, your kind of initial reaction, top line.
I'm actually going to single out two pieces, building on one thing, Aiste, you said earlier, right? So competitiveness and sustainability, how does it fit together? I actually don't think it's intended in any way, shape, or form to say that they are in diametrical opposition to one another, but to perhaps reframe sort of how sustainability fits into the overall competitiveness agenda, and almost to say, look, obviously reporting has a role to play. We need the right data, especially in capital markets, to reallocate capital flows in line with sustainability imperatives. But if folks end up spending more time on reporting than on actual sort of sustainability performance improvements, then things have gotten slightly out of balance. And I think that's very important to stress across the board, across the globe. Now, my slightly more European observation, and thus my second point, would be to say, I feel like mostly for European companies, there's sort of a macro timing and a micro timing challenge to keep in mind. And we can dive into more detail if you want me to, Mark, a little bit later. But let's just say, and this is now policy nerd alert, if you will, but some of the pieces of the omnibus are directives, meaning they require transposition not only at the EU level, but also by each EU member state in order to actually be legally binding, whereas others are regulations that only need approval at the EU co-legislative level. So therefore, for those directive pieces, companies, depending on which member states in the EU they're active in, don't just have to follow the EU news, but also the local member state news sort of to get to the final and legally binding answers to what the timeline will eventually look like for them.
Great. I think useful clarification, probably especially for everyone outside the EU, that with a directive, there's going to be an EU message, but Spain's going to make a decision, and you need to understand both across the many countries that make up the region. And glad you went back and hit on the competitiveness piece. I thought Aiste's summary at the start was great, and I was going to ask a follow-up question about, this is about getting sustainability and competitiveness kind of right or better in a sense, right? And I think this was the leading piece of legislation in the world, and now it's getting refined, and we're looking for a better output this next time around. Johann, you said you could go deeper on some of this. I'm going to invite you to do that right now. We got a hint from Jen about timelines. Things have been backed up a bit. So timelines are going to be extended, and the scope of what companies need to comply with is maybe going to be reduced, especially with CSRD. Why was that the path the Commission chose, and what impact is that going to have on businesses other than giving them a little bit more time?
I think we have to understand the history. Again, before CSRD and taxonomy became the key buzzwords, it used to be the NFRD, which only applied to large publicly listed companies in the EU. And there was a realization that if we want to drive sort of large-scale sustainability transformation, that's not sufficient. We need more companies to report comparable data. So that was initially what the CSRD and these other pieces of legislation were supposed to contribute to. Now, because of the geopolitical developments, now, Aiste, you mentioned earlier, again, that there was now a moment to sort of hit the pause button and rethink and refocus a little bit, whether too many companies might have been asked to report too quickly, perhaps. And just to put that into perspective, right, under the predecessor legislation, we're looking at companies that by and large have a history of voluntary sustainability reporting for 5, 10, in some cases, almost 20 years, right? But under those CSRD initial scope discussions, we would have looked at 50,000 companies, maybe a little bit more even, across the globe, some of which never ever reported on sustainability, not internally, not externally, right? And we all know that change has to be accepted by those who are affected by it if we want for that change in and of itself to be sustainable. So that's really the reason why timelines and scope are now being revisited.
Thanks, Johann, for giving us that kind of headline on timelines and scope and what the changes are looking like across the omnibus. I want to get into the 4 elements now. And Jen, you already broke down the acronyms for us, so I think we'll give ourselves permission to use them the rest of the way. And I'd like to get into the key changes related to each. And Jen, if you can pick up CSRD, then Johann and Aiste, I'm coming for you on the rest.
Sure. Thanks, Mark. So with the CSRD, the first change that was approved first week in April was a delay of 2 years for companies that were initially set to start reporting in 2026 on 2025 data. That's now been pushed to 2028. That has been approved. That is the only thing that is set in stone at this point in time. The second key element of the proposed changes is the redefinition of who is in scope. So taking a look at the 50,000 companies that we're going to need to be reporting and coming up with a smaller subset. The proposal has been that we've moved from companies needing to meet 2 out of 3 criteria, which were 250 employees, 50 million in turnover, 25 million in assets. That has now been proposed that it would go to 1,000 FTEs in what's considered a large undertaking, and either 50 million in turnover or 25 million in assets. So pretty significant increase in the size of companies that are being considered.
Is there an estimate out there, Jen, that'll take 50,000 to how many companies will be remaining in scope?
It might reduce the number of companies in scope by as much as 80%.
Got it.
There was a second phase, particularly relevant to my North American clients, which is that a non-EU based parent will need to report in 2029 on 2028 data if it meets turnover thresholds in the EU of 450 million. That was originally proposed to be 150. Now it's 450. So a pretty big increase there as well. No change in timing for those companies, however. Then the next piece that we are anxiously awaiting to hear on is EFRAG, which is the standard setting body that developed the ESRS. They've been asked to look at simplifying the required disclosure requirements. And we're looking at maybe a 25 to 35% simplification of that. So it's going to be very helpful. I'm anticipating a lot of the things that will be pulled out are the things that, none of our clients have figured out how to report on as yet. So that should reduce some of the burden on companies getting ready. And then also notably, the assurance that is required for CSRD reporting was initially set to start with limited assurance and move to reasonable assurance over time. And the proposal is to keep it at limited assurance. That's still a big lift that a lot of companies are not having all of their data and all of their reporting assured, even at the limited level today. But that certainly keeps things a little bit less onerous for companies as they transition to this regulatory reporting.
Thank you. Lots there. So, from 50,000 companies to maybe 10,000 companies, everybody's got more time, virtually a couple of years to prepare and figure out how to report. They will not need to report on so many different things, which in my experience, trying to do double materiality with people under CSRD, that's been a concern. So probably huge relief and a lower assurance burden. Okay, getting CSRD. Johann, taxonomy, can you break it down similarly?
I sure hope so. So taxonomy and CSDDD have always been joined at the hip because the taxonomy didn't quite say you are in scope of the taxonomy regulation because of, here's a list of criteria. It always said, if you're in scope of CSRD, you have to do EU taxonomy as well. So everything that Jen just said applies to the taxonomy as well, with a few tweaks and additions. The first tweak is, and I'm going to build on the size and headcount figures, Jen, you just aptly walked through. So it's also the 1,000 employees for EU taxonomy because of that CSRD trigger. But then instead of the either 50 million in turnover or 25 million in assets, suddenly we're talking about 450 million as the turnover threshold. So really quite the second additional hurdle in contrast to the CSRD. And again, I don't want to make this sort of a political who's who and what's everybody's view on that, but let's just say there is backlash against that, especially from some of the supervisory authorities in the EU. European Banking Authority comes to mind, for instance, but also the Platform on Sustainable Finance, which is sort of the EFRAG equivalent in terms of technical advisory behind the scenes, has said, like, hang on, it always supposed to be sort of CSRD and EU taxonomy. If you now put forward different thresholds, maybe that's not the best thing to do. Let's see where we will end up eventually on that, right? And then there's a few, I would say, quality of life improvements proposed under the
We
EU
all
taxonomy.
want quality of life improvements,
right?
and I did not expect to find them in the EU taxonomy. So bring them.
Yeah, here we go. So many of my clients previously complained about there not being any form of materiality threshold in the EU taxonomy. It just wasn't recognized as a principle as per the EU Commission's proposal to be introduced across a few different levels, both in terms of reporting itself, which KPIs, etc., but also in terms of those two steps of the EU taxonomy. And I'm quickly going to introduce those technical terms. Eligibility, meaning you do something that is covered by the taxonomy regulation, a different economic activity that could be I manufacture steel or I produce energy from solar PV, for instance. And then there's alignment, meaning for each of those economic activities, there's sustainability, compliance, and performance criteria. You don't have to meet them, but you have to report on whether you meet them or not, right? And one of those materiality thresholds being discussed is about not being forced to assess whether or not you align for economic activities where you don't really have any material volume of turnover, capex or opex associated with it. Again, to focus more on the material pieces within the reporting rather than trying to report on everything and anything. And then this is really more of an announcement, and there's not a lot of technical detail available quite yet. So definitely something to follow this space. It's about review, streamlining, simplification of those alignment criteria, especially, and I think, Jen, this is a point you will probably be able to agree with from your project experience. Those criteria have been written from a pretty EU-centric perspective, cross-referencing to a ton of EU law, which is great if you're based in the EU, but because of those third country reporting obligations that Jen has talked about, it's still a bit less straightforward to do so if you're based somewhere outside the EU.
Okay, I think tracking. So from CSRD to this like incredibly close sibling, the taxonomy, we're going to have a field or a universe of still fewer companies because of the size of enterprise, and they will probably not have to report on as many things, and they're going to get better, clearer guidance on which things and why. So we're kind of boiling it down, right, to what the meaning of the word material is, I think, really meant to be, and that's where some of the challenge and foment has been to date. Aiste, somehow you ended up with two parts. I apologize. Jen and Johann just got one. I'll trade you, though you don't have to go as deep on the other two. So just give us a quick headline on each of CSDDD and CBAM, if you can, please.
Absolutely. I think an important distinction, we talked about EU taxonomy and CSRD as siblings. I think that's a very apt description. CSDDD is more like a cousin. I think the focus on the taxonomy and CSRD is very much on disclosure. CSDDD is, yes, disclosure is important, but there's also a lot that the directive spells out in terms of action, specifically on due diligence. So it mandates in scope companies to identify and address human rights and environmental impacts. So not just in their operations, but in their entire value chains. And the proposed changes are, I guess, less in scope than EU taxonomy and CSDDD. So the number of companies remains unchanged. It was smaller to begin with, and it remains that way. It's about 6,000 EU and 900 non-EU companies, compared to about 10,000 as we talked about for CSRD. So a smaller number, mostly really large companies. The compliance timeline shifts by 1 year, though, to 2028. And a couple of other significant changes, and probably these are the most important ones. The biggest issue with the directive, has been approved, is that it has placed quite a lot of burden on smaller companies and indirect suppliers in global company supply chains. That will change. The proposal puts forward the idea that the requirement to scrutinize all indirect suppliers be removed, unless there's a clear indication of harm. And also the proposal puts a shield on smaller companies, and I think that's an important theme across the entire Omni proposal. I think the burden on small and medium-sized enterprises has been perceived as being simply too big of all these proposals. So there will be limits just to how much information companies can request from smaller suppliers in their value chain. And for CBAM, I think that's my favorite acronym.
It sounds best.
It just sounds really good. It could be like a name for a band. So Carbon Border Adjustment Mechanism, it essentially imposes a carbon price on imports of carbon intensive goods. And I think this is a good example. We talked about how the EU needs to balance the growth agenda and competitiveness with the regulation, the burden of regulations, while maintaining this very steady course on sustainability and transition to clean economy. So I think CBAM is a good example. So the EU maintains the goal of just making sure that the carbon intensity of the European economy drops, but it essentially will exempt approximately 90% of importers with proposed changes, while still covering 99% of emissions. So the goal remains the same, the burden decreases, and especially for smaller companies. And it will also clarify some of the rules for CBAM.
Yeah, I think like where you ended up there and that degree of emphasis on the balance that we're trying to find between small enterprise and what they can manage, but also keeping meaningful rules in place that address carbon and climate. And we've got to find that sweet spot between solving the climate crisis, which is with us and staying with us and growing, and dealing with the competitiveness issue and letting economies move at the speed that they need to be able to. Going to shift gears now that we've kind of worked our way through the whole family tree there, almost from our siblings to our cousins, and we knew who the parents were. We're blaming all this on the EU Commission still and what they decided to head off and do. Johann, I want to pursue timelines in a way. I think we've now covered kind of how fast the changes are likely to take effect and how much that might delay reporting timelines. But companies out there are already starting to issue CSRD aligned reports now. What do they do? And what about all the other folks who were preparing to in the next kind of 12 months? Like, do people stop and wait? Do they pull these things back? What's the next step?
You're absolutely spot on, Mark. And I don't think there's a one size fits all answer here. So let's start with sort of the compliance side of things. So if I only look at CSRD and taxonomy for a second, which were sort of the most live of the bunch, if you will, the so-called Wave 1 companies, or those previously affected by the NFRD, they would have published their first CSRD statements earlier in 2025, reporting on 2024. Talking about that stop the clock proposal, they're not affected by that because the stop the clock piece is designed to avoid companies starting to report to them potentially fall out of scope if those threshold changes come through, right? But that wouldn't apply to that first batch, or at least not the majority of them. So for them, it's almost business as usual, if you will, with a little asterisk, that asterisk being obviously as the underlying technical standards for reporting might get changed as well. You have to amend. But honestly, and I think, Jen, you mentioned that a little while ago, right? That preparedness, that starting point, it's very different from company to company. And for most companies, getting ready for CSRD, getting ready for taxonomy, getting that to a level of quality and sort of efficiency of reporting processes was never a 1 year process anyway. So, there was always an idea to sort of build out further as you go along and as you learn. I think for those other companies, it really depends on how far along you are in your process. I think there's a sunk cost piece to consider potentially, not from the perspective of saying, well, it's all been for nothing, what are we doing? But more from a perspective of, if you're fairly advanced, if you have that attention internally, why not keep building forward? Perhaps not with 100% speed, perhaps sort of putting on hold some of the pieces that are likely to be most affected by those underlying technical changes. One example here would be to say, all the quantitative disclosures are more likely to stay in scope as they are today compared to those in-depth descriptions of what are your policies, what are your management programs, etc., and sort of finding a more balanced approach as to how to progress. And then, Jen, you said it earlier as well, for non-EU parent companies, the timeline doesn't change whatsoever for that parent undertaking reporting. And then it really comes down to how mature is your reporting to begin with. If you still have a lot of homework to do, you might actually need all of the time you had planned anyways. If you're more advanced, maybe you can slow down a little bit.
I like the breakdown, and I think possibly a terrible analogy or metaphor here, but it's almost like something that was a sprint has turned into a 5,000 or a 10,000 meter race. And so you can slow your pace, but you want to keep moving. The comment about sunk cost, if you stop and have to restart, possibly going to be more difficult and more costly over time. And this is sort of giving folks the amount of time they might have needed from the beginning to kind of get this right. So for all of you so far through the conversation, it's been us as experts, it's been three of you as experts and me getting to talk to you, kind of breaking down the omnibus from our perspective. And now I'd like to do a bit of a speed round as we progress towards the end. And Johann, instead of our point of view, what have clients been asking you? What's an example of how companies have reacted?
We covered the timeline piece and am I still in scope quite extensively already. So honestly, there has been a ton of that. Other than that, it's really about what are the no to low regret options I can still progress with, regardless of sort of which batch, which wave of companies I belong to. I think honestly, the best short answer is focus on quantitative disclosures, because that's very certain to stay in scope. Everything else, you probably can get away with parking that, deprioritizing that a little bit.
Okay. And Jen, kind of pushing each of you into your regional corners here, are companies in North America asking the same questions or different?
We have a whole variety depending on where companies are coming from and what their plan for complying with CSRD had been to begin with. And I wanted to point out, an interesting nuance that sort of builds on Johann's last couple of comments. We have a lot of clients here in North America who were initially going to be in scope in 2026 for their EU entities. And some of them were choosing to go down the path of reporting for those EU entities. And then they would take the time to report on the enterprise level when that came into effect in 2029. That those EU entities now, their first reports will be due in 2028. The enterprise reports will still be due in 2029. So I have a lot of clients who are rethinking this and saying, oh, that, I was going to use that as a test case and ease into it. But now they're rethinking, does it really help us to develop an EU report that's only going to be valid for 1 year and then go to enterprise anyways? So in some ways, for some of my clients, it's actually sped up their timeline to getting to enterprise-wide reporting.
So that's a definite watch this space. I'll be fascinated to see what choices companies make given the rules they've been presented with, if the proposal goes through as designed.
And you can hear those companies asking, like, well, why are those companies getting the delay and I'm not getting the delay? And I point out, well, this is about maintaining the competitiveness of EU companies.
Yeah, different points of view. Aiste, quite a different question for you. So moving off clients, but something that I hear clients talking about and wondering. If the omnibus might be described as streamlining in the US, of course, the SEC climate rule is currently nowhere and not expected to reappear. So we'd have to say that we've got either reporting guidance being streamlined, reduced, and backed up a little bit in time. In some places in North America, it's being pulled back almost entirely at a federal level. What might that mean for voluntary reporting and for the ESG ratings and rankings world? Does it kind of push us back to a higher prominence of those things, or do they continue as they were?
Yeah, it's a great question. And I'll look at my crystal ball and I'll make a few predictions here. I think for the ESG ratings and rankings, what's interesting for my clients, there's been really no fewer inquiries about the ratings and rankings. Everybody still deems them to be very relevant. And I think with pushing out the timeline of CSRD compliance, that will again help them boost the relevance in the market. Also, I think what's interesting is that a lot of smaller companies now, based on the proposal, will not have to report. But however, they still need to be rated and ranked because the investor interest in this data will remain. So I think we might see a few shifts and developments in this space. So maybe ESG ratings and rankings will look how they fit in the compliance world. They might also look to orient themselves more towards the smaller companies that don't need to comply with the requirements. And we'll have the next wave of our Rate the Raters report this fall. We'll look definitely into some of these questions and try to come up with at least some trends or really forecasts on how this field might develop. So watch out for that. For voluntary reporting, I think what's interesting is that the EU Commission has said it, quite explicitly that the proposal intends to put a greater emphasis on voluntary reporting. So it's here to stay. And I think it's true for North America as well. Jen talked about North American companies and, the actions they're considering, given that the timeline for many of them has been delayed. They will still have to report. Many of them have been reporting for many years. So it's here to stay. And I think what's helpful is that the EU Commission, in fast-track manner, is looking at adopting new standards for voluntary reporting that will really help for all of those companies that are looking for just more kind of comprehensive and clear guidance on how to do that.
Great. Another watch this space place. And for us, I think the timing of Rate the Raters has never seemed so fortunate. It's a great moment to be diving into some of these questions and looking forward to that work internally and being able to share it with folks come late the second half of this year. We're getting close to a close. I'm going to ask a couple of wrap-up questions, but steer them differently at each of you. So Johann, I'm going to ask you, can you kind of expand a little bit on where we just were in terms of EU? I mentioned the SEC, we've touched voluntary reporting now. I'm going to want your final comment to be about what you think the impact of the changes in the EU will be on sustainability related regulation globally. And then Jen and Aiste, I'm going to come to you to wrap up just with one final piece of advice to companies on how to adjust to all this. So Johann, invite you to look out broadly, and lots of folks have been watching the CSRD and EU regulation for years on this and kind of following it. Are they still going to do that? Where do we go? And then we'll go to the advice piece.
I think this is an area where we have to step back from all those different acronyms, whether it's CSRD or SFDR or ISSB, SEC, etc., for a second, and really look at intent and, if you will, spirit of the law rather than letter of the law. I truly and fundamentally believe that this shift that started 5 or so years ago, when I say shift, I mean the trend of capital markets and regulators to really get sustainability reporting over time up to the level of robustness and reliability as financial reporting. I don't think this will go away. If you look at ISSB and all those sort of local adaptations that it has inspired, it's about financial materiality. If you look at sort of who's publishing that standard, it's the IFRS. It's literally the global standard setter for, general purpose for financial reporting, right? So maybe it's going to take a bit more time for global markets and for companies and for investors to eventually get to this point, because of what we're now seeing as part of the omnibus over here. I think that the broad objective, the direction of travel really does not change.
I think that there is that inevitability about it in my mind as well, that the issues are real. They kind of continue in their own right. We're trying to get the regulation and the reporting, to be accurate and useful everywhere that we're doing it. Aiste and Jen, Aiste, you've already had one chance to peek into your crystal ball on voluntary reporting. Going to invite the two of you to do it once more as we wrap up. What else would you tell companies to do as they wait for the proposal to move from proposal to reality, as they look at the global situation? Kind of what should be their next step? Aiste first.
I would like to double down on this topic of data, and I know that's come up. We've already seen an increasing focus on data by companies in the last few years, and it will be more and more important. So as we wait for clearer rules, one of the things that's super clear at the moment is that companies will need more robust data, and they will need to find ways to collect that across their entire value chain. And I think this is in particular relevant given recent developments in AI. We've seen the world change so dramatically in the last couple of years with the new tools. And I think they will need to be creative, and they will need to just investigate the best ways to do that. And the EU Commission actually has been also very clear that a lot of the changes in reporting requirements will shift in the direction of quantitative data.
There we go. So doubling down on data. And Jen, your bet is going to be placed where?
I think it's important to note that there's so many different areas and so many different topics on which companies need to advance. It's hard to do everything 100% across the board at the same time. So prioritization becomes really important. And I'd say, look beyond the regulators to what are your customers asking for? What are the expectations of those raters and rankers and other audiences? And even within the regulators, you look across all of the alphabet soup that Johann was talking about. And in North America, some of the state regulations, climate is sort of a no-brainer, is a good place to start, given it is the most common denominator for all of these requests that companies are getting. So prioritize and keep pushing forward where you can.
There we go. Good place to wrap up. I need to do my wrap, and it's mostly to say thanks to the three of you as speakers. Johann, Jen, Aiste, this obviously wouldn't have worked or been nearly so rich without each of you and all of you combined. Actually, that was kind of the fun part, was hearing where your voices met and where you brought slightly different points of view. To everybody listening, thank you as well. If you're a first timer again on Sustainable Connections and are now intrigued, all of the episodes are available on erm.com. They're also out there on your various platforms, be that Spotify or Apple or otherwise. And if there's a chance to get a rating or you would provide us a comment, we are always looking for that kind of feedback. For now, I'll just again say thanks to the panelists and wish everybody well as we move forward, waiting to see exactly where the omnibus takes us. Bye for now.